Stabilization seems to be prevailing. In this report, we aim to shed light on the factors driving WTI's price over the past week and as a future outlook. Making a start with the situation in the US oil market, we note that in the last week's release, the Baker Hughes report showed that the number of active US oil drills has increased for a third week in a row, this time by 2, in a signal that demand is on the rise. On the flip side though, we note that both API and EIA reported an increase of the US oil inventories, despite a relative divergence in the number as such, and thus tend to imply that demand for oil was not able to surpass production levels. Should US oil inventories continue to rise, especially if the rise as such widens, we may see the situation having an adverse effect on oil prices. Yet, at this point, we would like to have a look at a deeper fundamental level of the situation in the US oil market. The Fed's decision to keep interest rate unchanged tended to solidify the market's expectations that the bank has reached its terminal rate, and despite the financial environment remaining tight, that may allow economic activity in the US to improve further, thus increasing the demand for oil and thus pushing oil prices higher. It should be noted that the Fed's decision tended to weaken the USD, and should that bearish tendency be intensified, we may see it having a bullish effect on oil prices. On the other hand, we note that the US oil output, according to Reuters, has reached record levels and shale oil producers have become more efficient, a tendency that if continued could boost the production side of the US oil market and have an adverse effect on oil prices. Yet have to note that there is a fine equilibrium here, as lower prices may discourage shale oil producers from increasing production levels. The situation in the Middle East remains tense and the humanitarian crisis seems to be escalating, yet market worries for a possible widening of the conflict with the insertion of other forces. For example, other Arab countries, Iran or Hezbollah, seem to have eased. The easing of market worries was also one of the factors that allowed oil prices to drop somewhat over the past week. Nevertheless, the situation is still considered as being dynamic, and unexpected developments escalating the conflict may emerge that could take the market by surprise and push oil prices higher. Yet we have also to know that there is an increased conviction that the conflict has to reach an end at some point and that negotiations have to start. Uncertainty is still running high, though it's characteristic that Reuters reports that oil traders will pay premiums to secure annual supply of Middle Eastern crude oil. The release of China's manufacturing PMI figures for October in the past few days has not been so encouraging for oil traders. Both readings, the one issued by China's State National Bureau of Statistics and the other by private Caixin, dropped just below the reading of 50, implying a slight contraction of economic activity in China's huge manufacturing sector. The release tended to highlight how Chinese factories are struggling and stoke worries in oil market participants for a possible slowing of oil demand in the manufacturing giant. Overall, should the situation continue to indicate that the economic recovery of China's manufacturing sector is facing headwinds, we may see the issue exercising a bearish effect on oil prices. Thank you for watching.